हसदी हसदी मोर बह गई चौकी दे सार पूछा दे तू की जाने अनजाना मैनू बड़ी लिखी नू तकद ना पर देस दे मैं सदके लिखिया पढ़िया दी की जाने बड़ा सियाना
Please take your seats. Our program will resume shortly.
I'm a happy dreamer. I believe in love. I'm a happy dreamer. Guess I'm not the only one. I'm a happy dreamer. I believe in you and me. I'm a happy dreamer. I'm a happy dreamer. I believe in love.
The sun goes down, I'm getting scared, ain't got no chains, ain't got no home. The sun goes down, it's getting cold, world left me homeless, I leave this damn world. The sun goes down, I'm getting scared, don't let me down, my Lord, oh my. As darkness comes, forgive my sins, World left me homeless. I leave this damn world.
Please take your seats. Our program will resume shortly.
He called me Daisy, sometimes Doreen. He was a drunk lord, treat me so mean. I stopped him 4 times, begged for his love, was crying all night, a murderous cry. Long train is coming, ain't fast enough. The borders ain't far from this filthy old town. I killed my man, but I had my pride. I'm losing this fight, my peace of mind.
Please make your way back to the plenary. The show is about to start.
Don't let me down, my Lord, oh mine. As darkness comes, forgive my sins. World left me homeless, so I leave this damn world.
Please make your way to the plenary. The show is about to start. Please take your seats. Our program will resume shortly. Please welcome back to the stage, Eric Schatzker.
I promise you, everybody, by the time this is all over, you're going to have had more than enough of me. Welcome back. Hope you enjoyed your lunch. If you participated in a breakout session, I hope you found it fulfilling, interesting, stimulating. We have an excellent program to share with you this afternoon, and it's going to begin with a panel that I'm going to moderate. I told you you'd have enough of me. It is called Putting Private Capital to Work in Africa. And before I introduce my panelists, I do want to remind you that particularly for panel discussions, we moderators have the iPad. I'd love to have some questions from those of you in the audience. It always enlivens a conversation to know what you're thinking and what you'd like to know. So without further ado, my panelists for putting private capital to work in Africa. Raja Jandiala, she is the managing partner and founder of Yatra Ventures. Flory Lazier is the president and chief executive officer of the Corporate Council on Africa. And Rio Yamawaki is the partner at Verad Keppel Africa Ventures. Please join me in welcoming my panelists. Please. Well, where to begin? There are so many places in the world to make money, where the returns are high and the barriers are low. So, why Africa? Rio.
Sure. So, my name is Rio. Once again, I'm a partner at a venture capital called Verad Keppel Africa Ventures. Why Africa? I think it's a long-term shot. It's if you look at the macro, especially demography of Africa, Africa is the only continent that is going to continue to grow the population up until 2100. If you look at the labor force, I think more than half of labor force in the world will be Africans. So population means demand. Population means business. Population means opportunity. So that's why it's a long shot. So if you look at it in the short term, there's risks. There's a lot of.
We might just talk about some of those.
So I think it's a long shot, backed by population growth.
Raja, why Africa?
Can you hear me?
Yes.
Yeah, okay. For us, I think it involves sort of next generation human resource as well as next generation use of natural resources. And that means long-term commitment to the continent. I personally believe that given Africa's range of economies, for us, we're more into looking at what kinds of transitions are happening on the continent and where do we invest in what types of those transitions that are happening on the continent.
So it sounds to me, before I get to you, Flory, that both of you are thinking about investments in Africa in terms that go beyond mere financial returns, correct?
That's correct. Our goal is twofold, right? One is our philosophy is adding value to natural resources and adding value to human capital. And that kind of drives our effort. And if it has both returns and impact, great. But adding value is sort of our philosophy in how we approach any sector that we're working in. And that really, I think, is the way to go on the continent given the demographics of the continent.
And your clients, Rio, want a strategic toehold?
Yep. So my clients or my limited partners of my fund are mostly Japanese companies. And then they look at Africa, again, from the same perspective that they want a future market. And Japan has a completely opposite situation where population is shrinking. I think the fastest shrinking population in the world. Yeah, and then one of my the backers is Toyota Group, and they are suffering a lot from the shrinking market. So Africa. Toyota, yes, the car manufacturer.
Flory, you look at this through a slightly different lens. Tell us how you answer that question, why Africa?
Well, there are two particular trends right now, things happening in Africa, and it builds a little bit on what Raja was saying as well as the other folks here. One of them is that this is a good time to look at Africa because they are now implementing the African Continental Free Trade Area. And instead of investors having to look at 54 different economies, many of which are small and landlocked markets, with a combined market now of 1.3 billion people and $4.1 trillion, this is a great time to look at Africa and to see it as a continental market. I think linked to that is the fact that post-COVID, or during COVID, what we saw was a breakdown in global supply chains. And Africa really offers an opportunity for people to shift out of manufacturing and adding value in other places to Africa's products, but to do it where it makes the most sense in terms of the availability of the resources, the availability of the labor market, and to be able to transfer the technologies and skills that are needed in order for Africans to be able to supply global markets with everything from vaccines to automobiles, name it, everything in between. And so this is a good time for those two reasons, AFCFTA and shifting global value chains, to look at Africa.
In my conversations with public officials from Morocco and from elsewhere in Africa, they almost universally, to a man and a woman, cite the absence of private capital as the single biggest barrier to development. And given some of the extraordinary opportunities that exist here, they are consistently baffled by the lack of investment. Why wouldn't anybody want to come and bring their money? These countries need the money, investors have the money. What is the secret to bridging that gap? What is going to drive investment in Africa? Florian, I'm coming back to you to start with this one.
Well, I think this is one where there are two things going on. One is the perception of risk in Africa, which at least in the U.S., I can't say that that's true all around the world, but I think there are other places which suffer from this as well. There is a perception of risk that is higher than actually warranted on the continent. And so, people are like, well, I'm not sure. The other thing that is contributing are the ways to mitigate risk. How can companies do that, and lower their risk, the real risk that's in Africa? And I think that's where we have lots of tools and options for how to do that. I won't go into that now, but there are a lot of platforms which can be done. There's blended finance, where you can bring together, capital from IFIs, capital from DFIs, with private sector capital, so that the risk is mitigated in a way that encourages it. The last thing I'll say is also, at least for American companies, they are looking for predictability. They're looking for transparency. They're looking for the right investor-friendly environment that is going to allow them to come in and be able to bring their capital in, but also to be able to take their capital out when it makes sense. So those factors of predictability, transparency, rule of law, all of these are things that factor in.
I want to press you on one point. The perception of risk is unwarranted. Why do you say unwarranted?
Well, because, forgive me for being biased here, but I've been looking at Africa a long time. There are a lot of places in the world where there has been high risk in the past, and where investors have pushed through that. Even China, when companies were going there about 40 or so years ago and pushing into China, there were risks there. There were risks in the former Soviet republics. There's risk everywhere, but people have been willing to look past that to a certain extent. Unwarranted in the sense that I think someone said earlier that after Asian economies, and I don't know if that's all Asian or some particular group, Africans do not renege on their obligations in the financial sector. They borrow just like everybody else does, and they pay back. So what's the reason why you would think that Africa is a riskier place to do business, a riskier place to put your money, if indeed they are paying back what they owe? So that I feel is why it's unwarranted, and also because, again, there's risk doing business everywhere, investing everywhere, but why not look at Africa through a lens that says that we can get past those challenges and some of the risk that's there, and see kind of the opportunities?
I think maybe the other issue that we face regularly on the risk side is, I call it the myth of uniqueness. Because if you take all the countries on the continent and you compare certain national development plans and what's going on the continent, we mapped out about 17 countries that are on the path to middle income. So if you did not take the entire continent and looked at the transitions, right? Certain countries are first-generation post-colonial regimes. Some countries are transitioning in the post-war to first economic reforms. The others are beyond economic reforms and going toward, have goals to become middle-income countries and want to find sectors that are key to that jump in their economic. So I think I think one of the perceptions of risks has been not maybe making a distinction between the whole continent lumped into one. So anytime you hear on CNN, something happened in like Francophones are now going through a war to peace transition. The Anglophones went through it in the 1990s and 2000s. So when we talk to our investors, we say, okay, let's separate, and we do a little mapping exercise to say, if you're willing to invest in Ukraine and Afghanistan, clearly you can invest in East Africa between Kenya, Tanzania, Uganda, Rwanda. So we do a lot of sort of data, relying on, I shouldn't say this openly, but relying on general op-ed pieces or general bylines on the bottom of a CNN tracker doesn't give you the same sense of sitting down and mapping out these various economies and the status of those economies and where they are. So right now we're focused on saying, what is the risk related to countries on the path to middle income? That's a different, mapping out risk is as different as mapping out these countries' political transitions or security transitions.
Probably fair to say the single most important thing to do as an investor of any stripe in Africa is not to look at it monolithically, right?
Exactly. Because then you don't know what is driving, what is the underlying driving factors. As Flory mentioned about the Free Trade Act across the continent, we said, wow, we can't do the whole continent. Look at this Free Trade Act. We said, okay, let's take East Africa and say, what are these 9 countries doing about economic integration? And where do they stand in that regard about free trade?
I just wanted to jump in on one point that was made that Roger touched on, is the importance of going and seeing for yourself. And I just want to say that we are aware of U.S. companies that their CEOs are traveling to the continent, and they are sitting down and then coming back and developing strategies based on that vision that they have from being on the ground and developing some of the relationships that I think are necessary to do good business in Africa. You got to be there. Got to go to the continent. Don't just sit back in, back in the States or wherever you are and think that you know what you need to do in Africa without being present.
Rio, potential investors and actual investors cite any number of risks or issues they encounter when considering or even making investments in Africa. I could tick off a few: policy and regulation, infrastructure, political stability, rule of law, government incentives, multilateral support, corruption, education. How many of those do you run into? How many of those are issues for you?
All
of them.
So actually, I wanted to add some context to the conversation of risk. I think we have been talking about the maybe macro level risk as a country, whether they have how many barriers, what kind of barriers each country has to get to the middle income country, right? But if you look at it at a macro level, as a venture capital, because the types of companies that I back are very small, like maybe $1 million revenue, $2 million revenue type of companies. And then the variety of risks that we face on a day-to-day basis is mind-blowing. For example, mind-blowing because it's just huge everywhere. I come across risks, and for example, I was looking at a company in Sudan until recently. because there's a company very interesting doing a ride-hailing like Uber in Sudan. Very
Ride-hailing.
profitable. Ride-hailing, yeah, taxi ride-hailing, bootstrapped without any funding. Yeah, like a revenue close to $30 million, profitable in Sudan, mind-blowing. But I sent my partner to DD, and the day after he flew out of Sudan, that happened. Everything is gone. We spent 2 months doing DD, and it's gone. So that's the risk that we face every day. If you look at Nigeria, the currency, fuel subsidy, that affects day-to-day operation. That affects the PL, the exact PL of every single company that we back. So there are astronomical numbers of risks that we face, but still.
I mean, this sounds like a bit of an infantile question, so forgive me, but how do you get your head around that? How do you feel comfortable committing capital when what you just described in Sudan, you find a company that without external funding has $30 million of revenue, it's profitable, and then overnight it disappears?
Yeah, so for us, I think it's because of the nature of our business, which is a fund management, especially venture capital management. By nature, we put investments into in the bucket, different type of investments, different stages, but also different countries. By doing that, we diversify out, the kind of risks associated to any single country or any single region. So by doing that, what we're trying to do is to capture the opportunity that comes from Africa as a continent. Of course, we don't want to look at Africa as one thing, because when you make a decision, but when you manage risks, I think you have to deploy capital across different geographies, different types of investment, different phases of investment, so that you can protect yourself from a single failure, because failures happen.
Very briefly, I'd like both you and Raja to tell us a little bit about the kinds of investments you make. You shared with us some qualitative details. You told us you're a venture investor. You just described a couple of different scenarios that you've evaluated. What kinds of companies are you looking for, and what kinds of investments do you actually make?
Yeah, so again, I'm a venture capital, so we back tech businesses. And tech businesses that utilize software, or maybe hardware, but mostly software, to revolutionize how businesses or how industry is done in Africa. And then
Any particular sectors?
Broad, we are agnostic, but many are in fintech. And then if you back a company that has potential to truly revolutionize how businesses are done, then you have a potential to make a business with billion-dollar revenue. I believe, even in the software sector. So, like in Nigeria, we have one portfolio company that does a back-end solution for payment infrastructure in Nigeria. They process $200 billion worth of transactions every year. They started only in 2019. 3 years, 4 years, it's big. It's big. So because of these gems that we find in our portfolio, we are tolerant for risks. But most of the portfolio, actually, we faced all those risks. We feel like we are going to die tomorrow.
Raja, tell us a bit about your approach to investing. What are you looking for?
So a big part of our approach has been, what are the key industries that meet the current demand? So there's key demands: housing demand, demand for education. There's demand for energy, for example, the project we're currently doing in East Africa. And then we think those kind of fundamental, as we talk about base energy, there's some base infrastructure that's required for any company on the continent to attract capital. So we take three approaches. One is to say, what are the things we can do let's take a value chain. What part of that value chain is commercially viable? Is there a company that is working in that? If it's not, how do we then set it up and develop that? So that's one. Two is, are there any companies that are willing to do some early stage development work with us? And how do we partner? For example, we kind of said, okay, if the US firms are giving confidence to the markets, then let's partner with African capital. So Africa Finance Corporation is one of our partners, and they provided some early stage capital to get this going. For example, TDB, the East Africa Trade and Development Bank, who came in early along with AFC, said, okay, we want to partner with US investors who want to start early stage risk taking on the continent. Now, the project that we're doing in East Africa, it's approximately $4.5 billion downstream energy sector project. And so our approach has been, okay, if we put 60% equity, could we ask the region to put 40% equity? So a lot of times people want, the government to be the sole off-taker or want a government guarantee. But the minute you look at somebody's current account deficits, you know what those guarantees are value or not value, right? So if your import bill, you can only have a current account deficit that has, you can pay your import bill. You only have enough cash to pay your import bill for a month or 3 months or 6 months. You immediately know it's better to have their planning of equity contributions into a commercial enterprise, not through government. It's run as a pure business. So we kind of are having to mold, depending on the sector, depending on what part of the value chain we're in, we're having to mold a specific structure for that piece of work. So right now, we've agreed with the East African Energy Security and Transition Project. It's basically adding value to the oil that they've discovered. We're going to be producing LPG. And I think the earlier panel talked about clean energy. Well, I think, if you are 2% of the world's emission and you're relying on trees, you're already very green. You're just trying to be less green. And if you're in Texas, you're quite brown and you're trying to be less brown. So we're trying to make those distinctions and make those things to say, this is a massive energy transition project. We're willing to invest in it. We've brought people around it. And that's kind of how we're taking it sector by sector. And also we're working on cross-border, because you mitigate risks that way. If there are shared assets, and especially in East Africa, they've agreed to economic integration. So they've come up with a set of sectors where they want to go across the border. And we said, let's leverage that. Let's pick projects that the region needs as a whole, rather than country by country.
You're touching on a point that I think is worth getting into a little more. Earlier today, Caroline Bumbu, who's sitting right here in the fourth row, told us all that the secret to unlocking more private capital is de-risk, de-risk, de-risk. You just addressed one manner in which an investment can be de-risked, or at least the risk can be mitigated or spread. Flora, you touched on a couple of ideas earlier. If that is the secret, what's the secret to the secret? How do you de-risk?
Go ahead.
Okay, well, I was going to say that to answer that question, you have to really look at the different groups of investors, the different groups of private capital or types of private capital that's coming. So I just want to mention sort of like a few. So, obviously you've got the private equity folks, they're looking for certain things. You have the institutional investors in the US. Institutional investors don't invest in projects, they invest in funds. You have to look at what are the things that they are looking for in order to de-risk that, because they've got people's pension funds on the line, trillions of dollars worth of potential capital that could go to Africa. You could look at private capital that's coming from the African diaspora, for example, $95.6 billion, and that was like in 2021. It's more than that now. Most of that money goes into things like housing, school fees, and things like that. But what are the things that would need to happen to get those kinds of private capital investors to invest in the infrastructure, right? To go beyond their immediate families? What would that take? Then you have, in the US at least, African Americans is a whole other set of investors. Yes, we're a diaspora, but a different type of diaspora than what we're talking about with the 95.6 billion. Then you've got the African sovereign funds. I think I see here Obeid, who has the Africa Sovereign Investors Forum that they've started and is expanding. What are those kinds of sovereign funds looking for? So there's a whole range, and then you've got the DFIs, which obviously that's not private capital, but when you add to AFDB, Africa 50, TDB, AFC, what are the things that each of those are looking for?
I think the other issue may be also management. I think a big part of the entire process of investing is management on the ground. People who have to go sit in front of a minister, sit in front of a regulatory agency, sit in front. It's a constant day-to-day de-risking approach you have to take.
Hands-on.
Hands-on. Otherwise, you're not part of the development. De-risking starts at the development process, not when it's ready to be invested in. So we've said, okay, we have regulatory risk, we have institutional risk, so we need a full day-to-day de-risking strategy on a daily basis, not just you show up and you said, oh, I'm surprised this happened. Well, for example, I won't quote the country or the agency. We were about to put in some money, release some money, and they said to us, well, we've never done this before. We don't have any laws for it. I'm like, what? You want to talk about creating a law for this disbursement? And so it took our legal team, about 2-3 months to say, okay, maybe not make it a law. Maybe we start with a policy before you try to regulate it, because it doesn't exist yet. So that's kind of so we also provide we finance technical assistance to our counterpart, whether it's a public sector or whether it's a company. On every project, we try to set aside $2 million of pure technical assistance, so they then procure their lawyers, their commercial, so that way our lawyers we're not outgunning them in the deal that we're putting together.
Quick question for you. You mentioned earlier, and Flora, you may have a view on this, and for all I know, Rio, you may have a view on this. You mentioned earlier the types of non-private capital that you can source, co-investment, for example, incentive capital. A fashionable idea that I've run into in the global investment community that I'm sure you've all run into is this idea of first loss capital. And that if the multilateral organizations or the national governments agree to provide something akin to an insurance policy that would kick in if the investments or pool of investments started to lose money, then the private capital will feel a whole lot more comfortable coming in behind that. Is that is that practical, viable? Does it make sense? Will it happen?
I have a different view about first loss issues. If you are investing in a commercially viable enterprise, the government doesn't have to do things that are cash-based first loss. They provide regulatory enabling environments. They provide land. They provide power. They can put a package together that creates enabling environments that doesn't require cash from them, if you think you're investing in a commercially viable enterprise. Now, if you think that it is some type of a public good being implemented by the private sector where the risk has to be shared, then that allocation has to go through a real discussion of where that first loss can be recovered. So for example, we said in the project that we're doing in East Africa, we said, look, they said, are you sure you don't want a government guarantee? I'm like, I'll take the 40% equity, right? Like, if you can program into your national budget every year during the development process, $5 to $10, $15, $20 million, as you do to pay back the World Bank or anybody else in your budgetary process, then it's a better instrument. Now, I have gone to some of the DFIs for first loss. non-African DFIs. That's why I went to the African DFIs. But the non-African DFIs do take a lot longer. You know, we didn't have time for it. So we went into the private insurance market. And now, I think when it comes to Africa, we're also having to educate the private insurance market saying, look, we covered your risk up to this point. Can you pick up some of this? So we're talk about blended finance. We're talking about blended first loss. That's what is really needed in this investment climate that we're in at the moment.
Flory and Rio, I would like to give you both an opportunity to weigh in on that topic, or perhaps anything else you'd like to say before we run out of time and have to yield the stage.
Well, I would just say that, just building on a point that Raja made, that I think that despite some of the challenges, we really need to give kudos to the African DFIs.
Absolutely.
I mean, they have come a long ways. I think they have
Absolutely.
about $240 billion now in assets that they can put into things. And I know at Corporate Council on Africa, we've been encouraging our members and others to look at the African DFIs as potential partners on the ground with the experience that they have from this perspective. And then, you know, we sort of crowd in from the other side what the other DFIs and institutions have to offer. So I just think it's this whole thing of the blended finance, the sharing of risk and risk mitigation. I think that's all like really important. But let's give the African DFIs the credit that they deserve.
Absolutely.
Rio, when you and I were sitting backstage, you mentioned the importance of being able to exit. Is that something you'd like to elaborate on?
Yeah. So, of course, exit is very important. And then I think I feel like I'm throwing out a very extreme viewpoint because the type of, you know, like maybe your type of investment, you know, you get cash flow from the project, but my type of fund business is designed to lose money, actually, for half of a portfolio, and then you will get return from a single investment. So that's how...
The moonshot.
Yeah, moonshot. So you look for a moonshot, right? And then, but now we're still missing the moonshot, I'd say. So there are exits, like exits worth of maybe $500 million. Actually, there are two big exits from Tunisia this year and last year. $500, $600 million is a big moonshot, but still we don't have enough number to prove the thesis, the global thesis of venture capital. You can lose half of it or even 80% of you can write off everything except for an investment, and you will still make the return. Yeah.
So in other words, more chapters of that book need to be written.
Yep.
Raj, you wanted to say something quick, and then we do have to wrap up.
Just on the issue about driving private capital into the continent, I think fundamentally the continent also has to sell itself. Because I always tell my partners, I can sell the project, that it's commercially viable, we've done the due diligence, we've de-risked it, but the countries also have to market themselves in a way that gives confidence to investors to build upon their transitions, to show them we went from here to here, we're going from here to here. So they are the best narrators of their countries and their region, and I think that also should be encouraged because we can't rely on too much op-ed pieces on specific countries to drive capital into it. Thank you.
Africa, I hope you're listening. Ladies and gentlemen, please join me in thanking our panelists.
Please welcome to the stage our panelists. Minister of Economy and Finances of the Kingdom of Morocco, Her Excellency Nadia Ftah, Founder and Chief Executive Officer of the Global Sovereign Advisory, Anne Laure Kiechel, Managing Director and Chief Executive Officer of the Nigeria Sovereign Investment Authority, Aminu Umar Sadiq. Director of the African Department of the International Monetary Fund, Abibi Amro Selassie. And our moderator, South Africa Bureau Chief of Bloomberg News, Amu Mbata.
Welcome to my esteemed panel. I mean, when I heard that I was going to be talking to this very esteemed panel of speakers, I was very, very privileged. And of course, Mr. Abe joining us virtually, welcome again. I will be taking some questions from the audience. I mean, as the firstborn child in my family, I'm programmed to share. So I promise not to hog them all to myself. Public debt as a share of GDP in Africa has been rising quickly, exacerbated in part by the COVID-19 pandemic and Russia's invasion of Ukraine. The debt burden has been even more pronounced in sub-Saharan Africa, with debt to GDP around 56% last year, the highest level ever since the early 2000s. However, debt is not always a monster. When used effectively and serviced well, it can unlock massive growth and development. But if not, it can become a burden. As a major holder of strategic resources and commodities, there's no doubt Africa is a continent full of potential for fast-paced growth. I just want to kick us off with a general question for the speakers. How can African countries in distress leverage the resources and the commodities at their disposal to reduce their debt burden and risk? Minister, do you want to kick us off?
Thank you very much for having me to discuss this important topic of debt. As you were mentioning, there is a squeeze in the financing globally, but especially in Africa, and all my colleagues, ministers of economy and finance and government in general, are really struggling with the burden of this debt. I'm going to answer your question, but not exactly your question. You're right. Africa has big potential, many resources to create conditions for proper growth for youth, for in different regions, not rely anymore only on commodities, and create, I would say, more value, more industry, and so many reforms also on the fiscal side. And policymakers are really busy to reform and to create conditions for growth. But let's be, I would say, pragmatic. This debt crisis is due to shocks that are coming from outside Africa. And this raise in the cost and the burden of debt is first the tightening of the financial conditions coming from the West, from the US. Mm-hmm. It's coming from the raise in the dollars that hits, I would say, the currencies in Africa. And as a result, the spreads that are, I would say, valuating disproportionately the risks of Africa. The risk premium is more or less 3 times, and Unlock can confirm what we see in the emerging markets. So definitely, as policymakers, we have the responsibility to have the proper policies to manage this crisis, this debt burden, and create proper conditions for growth. But I think that the international community has also its part, and its duty also to help Africa solve this crisis in these unprecedented shocks that we are facing.
Abe, I saw you nodding. Do you want to come in?
Happy to. I think the minister really puts her finger on exactly what the challenge countries are facing now is. And of course, she's well placed to do so. For sure, there were vulnerabilities even before the pandemic. Debt levels had been going up, but for the most part, across the region, because countries had been investing in important areas like infrastructure, in health, in education. The increase in debt pre-pandemic, I think, reflected just the right approach. What governments did not do as well, I think, is collect the rates of return on this investment through the tax system sufficiently. But what has happened subsequently, the 3-4 shocks, and we tend to underestimate just how brutal these shocks have been to the region, to countries not as resilient, without countries without deep financial markets. That really is what's pushing countries to the edge, and in some cases, creating solvency challenges. In terms of how we respond, what the way forward is, again, I echo what the minister said. I think, where debt is clearly unsustainable, you need debt restructuring, and recognize that this debt needs to be treated. But the vast majority of countries are in a situation where they need a combination of reforms coupled with significant support from the international community. And I think that is the way forward. And, the debt challenge has to be seen as also a financing challenge, particularly in circumstances like the current one, where borrowing costs are keeping, elevated borrowing costs globally are, denying countries access to capital markets abroad. So, I'm very happy to note the IMF, of course, has been playing a very important role, supporting countries by providing liquidity over the last couple of years, and will continue to do so, and that's part of the answer.
Anne and Aminu, do you want to just take us through maybe the financing side of it?
Yes, maybe one comment, because when we're talking about the cost of debt, Minister is of course completely right about saying that the cost of debt is really too high. I'm going to even make it more caricatural, because most of the spending that government have to do are social spending. When you talk about health, education, if you borrow in the capital market at 8%, 9%, 10%, this is completely unsustainable, because you're not putting it to something that will yield those returns immediately. Of course, they will yield a lot of returns for your population, but this is kind of like a generation investment that you're doing. So to me, yes, we have too much debt, that's for sure, but we also, if I may, we may have the wrong debt, and that's what we need to be working on, because we need more of this concessional financing, we need more of this, when I call cheap financing, you understand what I mean by this, but at lower rate, so that the debt can be sustainable. And this will come and has to come from the IFIs that have already done a lot of work on this. We can be even more innovative with some blended finance, which I think is extremely important, so mixing kind of like the different sources of funding so that the cost of funding can come low. But I think we also have to recognize that because, and Abe said it exactly right, because of the shocks, we are in a very particular situation. Because before Africa, and I hate when we say Africa because it makes it, it's wrong, but I'm going to be too simplistic. But the countries were developing themselves. In order to develop yourself, you need to have resources. So yes, you needed to go through the debt. It's true what Abe said around the fiscal was not probably collected in the way that it needed to be. But because it is like this, what you have is fiscal that is not to the level it needs to be, the debt burden that has increased substantially, so you have almost no, if not limited fiscal space. So when a country has to choose between repaying its debt or doing health or education spending, I mean, it's completely wrong. Mm-hmm. So we need to address this as an urgent matter, while we also need to recognize that down the line, we need sustainable economies. And developing an economy, doing exports strategy, doing economic growth, this is not something that you do in 1 year, in 2 years. Those are a very long-term rhythm. So we also need to recognize that the problem is short-term, immediate, while part of the solutions are also long-term. And this discrepancy between short-term, medium, long-term is very hard to kind of like fix, and that's the problem we're currently in.
Aminu?
Perfect. Honestly speaking, I align very well with all that has been mentioned by my colleagues. I think my contributions would be threefold. I think the first is we also have to determine how we leverage local currency, long-term capital within these frontier economies, particularly pension funds and insurance companies. At the NSI, we founded a company called InfraCredit that essentially is a financial guarantor that provides guarantees to bonds issued by local companies in order to motivate domestic capital from pension funds to infrastructure projects. And I think that has worked exceptionally well. That's the first thing. The second thing is, from an industrial policy perspective, I think countries also have to find a way to encourage both backward integration as well as forward value addition for a lot of these minerals that we are blessed with. And I think thirdly and finally is on the tax side. I think when you look at African economies, particularly ours in Nigeria, relative to our GDP, our collections is really, really low. For a plethora of reasons, but I think principally that trust between the government and the taxpayer really, really needs to be developed so that taxpayers are sure that there is a return on the tax receipts that comes from their business to the government. But I think if the governments can mobilize that collaboration between government agencies and put in place the apparatus to enhance tax receipts, I think there's also a potential funding source more effective than debt.
Right, and Abe, I want to come to you, particularly on the tax side of things. What do you think are some of the reforms that we could see in some of the countries that need to improve their tax to GDP ratio? What should be done in terms of perhaps repairing that trust that Aminu talked about?
Yeah, Aminu, I think made a very important point, which is ultimately how much governments are able to collect by way of taxes is about the social contract that people feel comfortable with paying taxes, comfortable that the resources are going to be used in the right areas and the right ways. Second, I think so just on the first point, it's important to make sure that, of course, governments can demonstrate that the money that they're collecting is going to the right places, minimizing corruption, making sure that you're getting value for money in the investment projects that are being selected, fewer vanity projects and more projects that really appeal to our populations. Investments in health, education in particular, that Anne-Laure also touched on, really, really very important part of the equation. But second also is that a little bit more bravery, I think, is needed by governments to go out and collect taxes. There are a lot, in many of our countries, you have a lot of tax incentives, which I'm not sure are always needed to entice investment. So broadening the tax base, minimizing those kind of incentives only to the ones that are absolutely necessary will be important. There's also quite a lot of activity that goes on in terms of, companies seeking to minimize the tax burden, shifting taxes through transfer pricing. So trying to get at those will also be really very important. So it's a combination of those things that will be important to ensure that tax to GDP ratios over time can go up, in our countries. Now, at the fund, we do a lot of work supporting countries, both on the technical side in particular, but I have to say that the political side is as important, the will to go and collect these taxes. And our experience is that, on average, countries are able to, when they put their minds to it, collect between 0.5 and 1 percentage points of GDP a year. To collect, and so if you can sustain that over a 3-4 year period, it really, moves countries to a level where they should be able to, minimize the debt servicing burden in the vast majority of cases.
Well, China is the biggest bilateral lender in Africa. How crucial is that relationship that China has when it comes to the debt crisis?
It's a very interesting question because we always have to go back to the initial time where China landed. Because we sometimes tend to be looking into now versus when it happened. It actually happened a couple of years ago. And at this time, it was also because the risk of Africa was potentially not very well measured, that at a given time, China decided, well, we want to invest in Africa. Of course, they had their own agenda. I'm not naive about it. But they were the ones who could provide capital on projects. And more importantly, they were providing capital, long-term capital. So typically, if they had infrastructure, they were willing to provide 10 years, 20 years money, which kind of like you couldn't find in the market or anywhere. And because they had this system of contracts and financing, the financing looked on paper very attractive because it was low rates. Actually, the value was, split between the two, but still it looked kind of like attractive. So at this time, you had a surge of countries to develop their infrastructure with China money, and of course for China to also have their own companies develop the economy. So now it ends up that indeed the debt levels are too high, and that one needs to be thinking about restructuring, grace periods, as Abe said. But in order for it to be also acceptable by China, we cannot forget the past and the circumstances of the lending. We cannot forget the diplomatic relationships that countries have with China. But now yet, faced with a debt crisis, every debtor needs to make an effort. And if you're the largest lender, you of course also need to make an effort, give grace periods, extend the debt, and if and when it's acceptable, haircuts and necessary. So all of this is a package. But I just wanted to put perspective, because I think if we do not recognize this, somehow the discussions are going to be much more difficult with China not accepting this.
Right. Minister, I want to, bring a little bit of positivity to this conversation. Morocco's bid to get off the FATF grey list has been successful, a positive development, of course, which will likely make it easier to raise debt and improve investment ratings. What are some of the lessons learned and the opportunities that lie ahead for the country and its development, especially after Morocco issued a $2.5 billion bond on the international financial market?
Actually, under the guidance of His Majesty the King, Morocco has always been committed, actually, to push terrorism and anti-laundry money. But we had this conversation with Gafi saying that we don't comply with all the processes. So we had, I would say, to have a proper task force to get out of this grey list. What we need to understand in our economies is that the financial sector, because it is, I would say, in worldwide standard, are quite familiar with these processes, have the proper technologies, have the proper, I would say, talent experts to do so. The challenge was the informal economy, the non-financial economy. And we explained that we have cultural way of doing, I would say, business. Women in our countries, I would say, their savings go into gold. So they won't go to any administration to just disclose how much gold they're hiding from their husband or mother-in-law. So what I need to say is that definitely to do so, to have all the stakeholders committed, I would say, to do all the effort to go out of this grey list, you need a strong leadership. So, of course, we have the leadership of our Majesty the King, but also the Prime Minister have put a lot of energy, because you cannot, it's not the problem of the financial sector, of the Minister of Economy and Finance. But it definitely helps to get, I would say, better financial condition. But let me tell you that the financial institution, the financial communities knew about Morocco. So we were, I would say, blessed to raise this $2.5 billion. We could even raise more, but we are taking care of our microeconomics and debt level. But the financial community has some type of intimacy with all the IFIs, with all the financial institutions. I know very well how much Morocco has been doing strong reform, have a very strong, I would say, agenda of macroeconomics, I would say, reforms on the midterm. So it's not the fact that we are going, it helps, definitely helps, but what helps more is to have, I would say, a vision, to have an ambition, and to have real milestones and KPIs, which I think we are delivering in Morocco. So you were talking about the tax revenues. We used some of the recipes that Abe have just described, and in 2021 we could raise the tax revenue by 21%. We did the job on the corporate side, building trust, having, I would say, a mid and long-term, I would say, visibility on tax. It is important to build trust. But on the other side, what is important is our agenda of social protection helps also a lot to increase the tax revenues. because people were not willing to register at the Social Security Agency. They just see it as another way for the government to collect additional taxes and fees. But the moment they see they can benefit from Social Security, that they can go to hospital, they definitely are willing to pay for their own taxes.
Hopefully that will also resonate in Nigeria. But I mean, I wanted to bring you back maybe to a currency aspect. The Naira, I will tell you, on a Bloomberg News perspective, any story on the Naira goes viral on the internet. How would a Naira devaluation, as it is expected, impact the NSIA's assets and investment outlook, would you say?
Just to give context, NSI is actually organized in 3 separate and ring-fenced funds. We have a stabilization fund that provides stabilization support during times of economic duress. We have a savings fund for intergenerational equity. Both of those funds are actually fund of funds. And then we have a domestic infrastructure fund. Our source of funding is actually in US dollars. So the receipt of funds from the sovereign is in US dollars. And we hold our capital in US dollars. So to the extent that there is any devaluation, the impact is very minimal.
Right. It looks like the audience hasn't sent in any questions over, but please feel free to send some because this is a riveting discussion. But Mr. Abe, I want to just bring us back again to the common framework, which is proving slow and cumbersome in process in getting creditors like China to work with traditional Paris Club lenders in agreeing to debt relief for countries like Zambia, for instance, which faces a cash flow crunch if debtors can't find a common solution. China, it seems, has faced a lot of blame for holding up that process, especially from the US. Has the common framework become a new battleground, so to speak, for these two world powers? In other words, is it a case of the grass suffering as two elephants fight?
Very
easy. Good luck.
Yeah, I mean, I have to say I have issues with the framing of the question. So I think stepping back, these are points that Anne-Laure made very nicely earlier. I think what clearly happened in the 2010s was China emerging as a very important source of financing for developing countries, notably in Africa. But still, I think it's really important to put some numbers in context in terms of obligations to China by African countries. I only have the number for sub-Saharan Africa at hand, but I think China obligations to China account for about 6-7% of total debt of sub-Saharan African countries. Now, within this number, there are a number of countries, I would say 7-8 countries, where the share of debt to China is quite significant. So I don't want to overlook that. But one challenge that we had was, of course, China not being part of the Paris Club structure. We did not have a forum where bilateral creditors, and China had become a really important creditor, could discuss how debt to the official sector would be treated. So the creation of the common framework, I would say, was a moment in time when the pandemic hit, when we were all working together, which brought China to work closely with Paris Club members in the context of the G20. So it actually was one of the ways in which, if you will, the global powers were agreeing to find a way in which they would work together. So in that respect, I think common framework, in contrast to the way you framed the question, was actually the coming together of and the creation of a multilateral spirit to help address the most vulnerable countries with the debt challenge as they are emerging. Right. Now, that said, I think, given the fact that you now have new creditors who've never provided debt treatment, like China, Brazil, several other countries, it has taken quite a bit of time to come up with debt treatment, and this has been to the detriment of countries in the region. But I have to also say that it is a very, very important framework, and it is slow, but it is making progress. So just to give a couple of examples, I mean, Chad has already gotten debt treatment. And that has already been ticked off. Of course, we've had initial agreement to provide financing assurances so the IMF could proceed with providing financing for Zambia, also for Ghana very recently. And we're now waiting for a final, reaching understandings on a memorandum of, an MOU, memorandum of understanding with Zambia, and very, very active discussions are taking place. And we're very, very hopeful that something will come through in the next few weeks. So there is progress, albeit slow. So I don't think we want to throw the baby with the bathwater. And I think the common framework, just needs improving.
What is very important from what Abe said is the diversity of creditors that you have. Because we are talking about China, and he mentioned a couple of others, but you also have India, who happens to be also involved in a lot of situations, Turkey. So indeed, the complexity of the debt, be it on the bilateral side, as we are discussing, be it also more on the multi or plurilateral side, because you have also a lot of entities that have emerged more recently, also on the regional level, right, that kind of like also create new categories. And of course, those countries, and a lot of countries, have also accessed the bond market. So you can sometimes be successful, as Morocco was highly successful, but sometimes you've incurred too much debt, you then cannot go back to the capital market. It's a very dispersed market, because who is actually your creditor? You may not know them in themselves, right? They may have changed. So all of this, in fact, we're talking about debt complexity. What the common framework aimed to achieve, I'm making it now super simplistic, but was to try to have a frame to deal with those complexity. So, of course, it's never going to be perfect, because each country has some specificities, right? But this is what we have to face, a multi-complex bondholders or debt holders with different layers of debt, different types of debt, making it hugely complex to solve. So I guess the point is, let's try to avoid restructuring if we can. I guess that's what we are talking about.
Exactly, and that's why it's so important to have these kind of conversations. So we're running out of time. In 30 seconds each, what can the international world do to aid, to support the resolution of Africa's debt crisis, Minister?
In 3 points, hopefully it will take 30 seconds. First time, without being provocative or not blaming anyone, I think we need a timely response. SVB, it took 2 weeks to find a solution. We still discussing MOUs for Zambia, Chad, etc. So I think, we are running out of time. Second message. The annual meetings of IMF and World Bank are taking place in Marrakesh, October this year. 50 years back, it's been 50 years that they have not been back to Africa. So hopefully the MDBs will come with proper solutions for the African continent and globally for the middle income and the vulnerable countries. And the last point, we didn't have time to talk about it, is governance, because we just used this type of conference, and I would like to thank the organization to raise the voice of the Global South and Africa, but we need more, because we don't have enough representation. We don't have representations in the G20. We don't have enough voting rights. So something needs to be done around governance for this continent.
Abe, 30 seconds.
I'm tempted to say I strongly second everything Minister Nadia said. That's very much something that we're working on, including for the annual meetings. But just 2 quick points from my side. I think, in terms of easing the debt burden for the region, the solutions are going to be very country-specific. Not only is the creditor base very different, but also the particular circumstances of the countries are very, very different, and the needs are very different. To the extent we can generalize, I think 2 things are needed. One, most countries are facing a liquidity crunch, and for those countries, significant external financing, which is at concessional level, is really needed to help the region go through this difficult period and avoid even more difficult debt challenges going further. Second, I think also, there are long-term challenges to which Africa has not contributed, but is facing the brunt of. The climate, of course, is one of those. And I think, the international community would be being incredibly myopic by not investing in the labor force of the future. Africa will be providing the lion's share of the global labor force going forward, and it really is important that we invest in health, education, infrastructure now, so that we can have a resilient region going forward.
Anne?
I would like really to strongly echo the point on liquidity, because if I may, and Ave will not like it, but sustainability can be dealt with. Liquidity, you have a strong issue when you have a liquidity crisis. So I think this should be really our priority, maybe more than the sustainability to start with. First comment. Second comment, and I think it was a very good comment made on the local currency. We didn't really have time to discuss this, but when you have a currency mismatch, when you borrow in dollar or euros, and when your currency is a different one, I mean, clearly you're putting yourself into an extra burden. I know it's also a priority and things that people work on, but we need much more to develop those local markets. This is absolutely critical if we want sustainable economies.
Great. Aminu?
It's the problem with going last. All the great points have been made, but I think the only thing to add is empathy on the part of the creditors, particularly because, this issue around debt restructuring has been a movie that has been played over and over and over again. So just appealing to them to still retain that empathy as to what the impact of debt renegotiations are on the one hand, but on the other hand, there also needs to be responsibility on the part of the creditors that debt forgiveness comes with a certain amount of commitment to governance, to sustainability, and to detailed thought processes around the utilization of these funds.
Thank you so much. We could talk all day about this subject, of course. We'll continue it next year, right?
Okay.
Thank you all. Thank you.
Please welcome our panelists, Managing Partner and Chief Executive Officer of Alta Semper Capital, Afsan Jetta, Area Medical Director of the Middle East and Africa at AstraZeneca, Viraj Rajadeksham, Chief Executive Officer and Chairwoman of the Board of Sothema, Lamia Tazi, and our moderator, reporter at Bloomberg News, Janice Q.
Afternoon, everyone. I think this is a cunning plan to have such a interesting and important topic as our last session for the day. It helps keep people connected. Talking about being connected, we will have that a QR code up there so that we can take audience questions. I will see how we're going on time and do my best to incorporate them. So with the COVID pandemic, we certainly have a lot of people who want to move on from it, and that is very understandable. We would not be meeting here if we weren't able to move on from it. But with Africa, we have seen through the pandemic that as a continent, we've been able to work together really well, and it's mobilized us on the healthcare front. Even so, we have very little capacity, homegrown capacity, in terms of vaccine making and pharma generally, even though we use a fair bit of the global vaccine demand, almost a quarter, we only produce about 1% of what we need. So looking at the future of drugs and vaccines in Africa, Lamia, I wanted to start with asking about Morocco. And out of a handful of countries on the continent, It does produce vaccines. It produces a lot more too. What do you feel has been the main drivers enabling that?
Okay, thank you. Thank you for inviting me in Bloomberg at very interesting session. So my experience is very positive with COVID, and I can tell you about this positive experience in Morocco also. COVID was a crash test for all the countries, and we didn't see the difference, unfortunately, between West and East and the South and North countries. And Morocco has really a good experience in this COVID time. And this is due to many factors, but the main one was the involvement and the goodwill of the supreme authority, which is our king, Mohammed VI, who really handled all this matter from the beginning. So in 1 year, Morocco succeeded to have a clinical trial for a vaccine, for COVID vaccines. In 1 year, we succeed to manufacture a vaccine in Morocco. I'm very glad to be part of this experience, because my company was involved in these clinical trials, in this manufacturing. So really live a very big experience. And for the first time, I think, in my life, and in my life in pharma industry, it's long now, is the first time that I see that cooperation between public and private was very strong. And we saw how it goes very quickly when partnership is here and when we have the same goal. So this is the first, and thanks to our king. First thing, what is important to know about Morocco also, and it's due to thanks to the strategy of Morocco 50 years ago, its incentives put in for pharma industry. It is very important to say, because we will talk after about Africa, and as a company, I'm also in some African countries, and we see the Moroccan model, and we see that if it is this, it could be the same in other countries. I think Africa will have another image in terms of health and in terms of medication. So in Morocco, thanks to all these incentives and some laws to protect, we are producing more than 70% of our demand. That means that during COVID time, the agility of the companies, and here we are talking about national companies and also big pharma who are implementing in Morocco, and the agility they work with, the efficiency, we didn't have any shortage comparing to other countries, and probably nearhood countries would have many shortage, and we were able also to give to our neighbor African countries some medication that they don't have, because you know that during this COVID time all the frontier was closed, and yes, so it was very difficult to have medication. So in general, it was a very positive experience, and what is more positive is that health now is in this stage. So we know now that health is very important. Yes. And the autonomy and the sovereignty of a country in terms of medication and in terms of health is very important also. Yes. So I hope that it will be a warning for all the countries that they have to start to thinking more about this.
Viraj, I mean, health is important, but it's also complex. And with AstraZeneca, there is certainly moves in terms of diagnostics, in terms of clinical trials. These are important parts of the puzzle. Do you want to talk about that a little bit, and what can be done and why it's important?
Yes, thank you, Janice, and thank you, Bloomberg, for giving me this opportunity to talk to all of you. I will try to divide your question into two parts, diagnostics and R&D or clinical trials. And in the diagnostics part, what is important is we all know that if we diagnose individuals much early, then they have a better outcome, they have longer lives, and in certain conditions like cancer, they definitely have longer survival as well. But this is not only pertaining to cancer, it's also pertaining to diabetes, to chronic kidney disease, etc. So what we are doing is in various African countries partnering with societies, with community groups, and trying to identify these individuals much early through education, through awareness, through screening. For example, in breast cancer, through certain laboratory types of screening, let's say in prostate cancer, and we also use artificial intelligence-based solutions in certain conditions like lung cancer. And with all this, what we are doing is we are identifying individuals at an early stage and probably giving them a chance of quote-unquote cure, which we don't commonly see in cancer, but we are seeing with the availability of new medicines. So this is what is happening across the whole of the African continent. You talked about clinical trials, and when we look at clinical trials, we often feel it is phase 2 and phase 3 clinical trials, and these are important programs. But we must understand that the capability and the status of every country in Africa is different. So when it comes to phase 2 and phase 3 clinical trials, we know that countries like South Africa have an historical advantage because they've always been participating in global trials. But we also know that in the recent few years, with better regulations, countries like Egypt have a significant advantage over others because of good health infrastructure, because of large number of patients and healthcare centers. So these are countries where we are doing phase 3 trials, across many indications. There are other countries, where we will then have to start with real-world evidence studies, which are also very important because they talk about treatment patterns and demographics in that population. If somebody asks you, what is the prevalence of lung cancer in Morocco, you will probably go through individual centers. But if there are registries that are created, then it gives you a nationwide picture or a continent-wide picture, and that is what we are encouraging to do. So to answer your question, with every country, there has to be a different approach because all of them are at different stages of evolution, and a solution that works in one country may not necessarily be the solution in the other.
Absolutely. I mean, it's the classic thing that Africa is not a country, it's a continent, and there are a lot of different countries, not just by regulation, but also by burden of disease. Afsane, one of the other important parts of the puzzle is funding. What do you feel are the biggest hindrances that we're seeing at the moment in terms of funding? I mean, healthcare has been mentioned on several panels today, along with education, as one of these really important things to have funding for in terms of ultimately economic growth in a country. But it is a social spend in many ways, and that's sometimes a hard sell. What do you think are the hindrances, and also how can we improve?
Absolutely. So as a large investor in social infrastructure in Africa, largely healthcare and increasingly education, we do see it as a huge opportunity. It is the primary focus of our funds. I think one of the things we've learned from the COVID crisis, and they say you should never waste a crisis, right? And there were a lot of learnings from that, and one of the wonderful learnings was the public-private partnership. I think one of the biggest hindrances for investing in private healthcare on the continent has been, with very few exceptions, who is the payer of goods and services. So, Africa does not have. Africa is a continent with several countries. There are very few countries that have moved towards universal healthcare. I would say a huge congratulations to Morocco. It's been one of the more visionary and progressive countries. And as a result, you've seen a huge amount of investment successfully and profitably into primary and tertiary care in Morocco. I think one of the biggest hindrances is the lack of a government payor system across many economies, but also a dearth of investment, not simply in vaccines or in pharma, but across the whole patient care pathway and the whole healthcare ecosystem, including health insurance, including investments in human capital. As an example, a country like Côte d'Ivoire has 14 oncologists across the whole country, and the likelihood is by next year, 7 of those oncologists will likely be living in Europe, right? So it is very hard for a private investor to rationalize investing often tens of millions into pharma, into tertiary healthcare, without the reliability of knowing there is the human capital to support that ecosystem, but also that there is either a government payor or a sufficient coverage for the population of private healthcare. And I will say that in itself is an incredible opportunity, right? Governments in Africa, particularly post the COVID-19 pandemic, tangibly realize the importance of the health of their population, but also the importance of having health security nationally. And investing in universal healthcare will allow the private sector to invest and create local solutions for these local markets that won't be subject to vaccine nationalism. And ultimately, if you build great hospitals and great research facilities and great primary care centers, you will then also encourage the human capital to want to stay in country and contribute.
Biraj, you've got an interesting project happening in Kenya. I think it went live in April. Would you like to talk us through that a bit?
Yes, so I think the situation in Kenya was that for lung cancer, for a particular genomic markers, and as you know, the diagnosis and treatment of cancer now is based on personalized medicine. That means you have a biomarker, and then if the biomarker is positive, then individuals have access to targeted treatments, and it is proven that targeted treatments are associated with better outcomes and lesser safety issues in those identified populations. And for the testing of EGFR mutations, which is in about 15 to 20% of the population, the samples had to be sent outside the continent, and this was happening. Now, if you need to build the infrastructure in Africa, we need to partner with societies. We need to partner with healthcare institutions and build the infrastructure here, not build the infrastructure somewhere else. So that's what we did. We started collaborating with an healthcare institution in Nairobi. And we said, is there an interest? And they said, yes. You know, could you help us with technological transfer? Could you help us in updating our own skills and capabilities? And as a result of that, we are very happy to state that effective 1st of June, this center has gone live, which means EGFR testing for non-small cell lung cancer will now happen in Kenya. And we also worked along with the public sector and private sector. Can these benefits then be provided to the wider Kenyan population and not only to the population which is coming to that hospital? And these are innovative models of healthcare that we should look at. So it gives us immense, joy on one hand, but also pride that we have partnered to build something which did not exist on this continent. And there are several other examples across the area where we have done that. For example, last year we did it in Saudi Arabia, where all our genomic markers are actually tested in Saudi Arabia, and we do not export it outside. That's a partnership between a pharmaceutical organization and the healthcare system.
And reduces a lot of time. Lamia, in terms of the barriers to developing full domestic, whether it's vaccine manufacturing or other pharma, what are you seeing as the main barriers?
There are many, and I'm still optimistic.
Good.
But there are many. I think the first one, and perhaps I will open a passionate debate concerning the IP protection. So everyone heard about, the dispute concerning the IP for the COVID. And we can talk about this problem for every medication we have. So when we are talking about equity and sustainability, we cannot accept the level of medication we have now, and especially in chronic diseases and in some diseases which are endemic now. So this is really an issue. I'm talking as a Moroccan company and national company who wants to help Morocco and Africa to go forward. So we cannot develop a product until the patent goes, and it takes 20 years. This 20 years, 50 years ago or 20 years, we didn't see it because we didn't have all information. Now it's mondialization. Everyone knows everything about everything. So it's very difficult to stop this, and I think that we really have, and now it's Bloomberg, so we are with Western countries and African countries. We really need to address this point, because we are seeing in Morocco now it's a very, very big challenge of covering all the population, and it's a big challenge that our king take also after COVID, is to take all the Moroccan into insurance, and I think, and we all think that it is the solution for health for all the countries, but they cannot do it with this kind of level of medication. So we have to find solution, and solutions is first given the opportunity to manufacture this product as a low price and give the opportunity to do it locally. So this is the second barrier. Unfortunately, there are many Africas. There is not one Africa. And each country, and we don't have the market to develop. When a company develops a product, if you sell it in Morocco, you will perhaps amortize in 30 years. If you develop it in Europe, as its regulation is harmonized, it is opened, you can just amortize. So this is really a point that we have to work together. And we are talking about ZLECAf and all these things. But I think that when you are on the market, it's not the case. So we have to go in each country. Each country has her regulation, its distribution way. And in this case, it's very difficult to think Africa. Unfortunately, there are companies in Africa and some countries, and we talked about Egypt, we talked about Kenya, we talked about Morocco. We have technologies. So we don't need technologies from outside, but we need to work together to implement it and to be part of this change in Africa.
And governments, potentially taking the knock, so to speak, financially, by creating the demand, having the uptake, even if it's a little bit pricey initially, because of the long-term view on that. Afsana, you touched on the human capital aspect and migration, but one of the things which I've heard a lot of people say who have potentially left their home country is that their granny or other relatives are still there a lot of the time, and healthcare is so fundamental, especially as people are aging. You spoke to me earlier about telehealth and had such an interesting example then. As you mentioned human capital, I was thinking, when people are seeing their relatives being helped for the first time, that would be quite an attraction to stay if they felt they could be part of that. Would you like to talk about that? I think one of the interesting points you made is how we see in many parts of Africa people moving out of the cities as they age.
Absolutely. So one of the investments we've made, one of our first tech investments, is we've made an investment into a business called My Dawa, which in Swahili means My Drugs, which is the largest online pharmacy in East Africa. And a great collaboration we had with the Gates Foundation is they gave us a grant to also build out telemedicine. So one of the huge opportunities in Africa is that it is white space, and you're often not competing with other companies to gain market share, but you're actually in itself trying to create a market. So we were thinking of creative ways in which to get more patients and to get more people to use our online pharmacy service. And we did a trial in rural, sort of semi-urban Nairobi, where we sent a region a text message saying, text this number if you would like to see a doctor. And the dynamic was a lot of older people move out of the cities and are entirely reliant on their families and children to bring them medication on the weekends when they have time, when it's convenient. We had expected we would get 200 to 300 responses. We ended up with 4,500 responses of people who wanted to see a doctor. So we had to stop the campaign because we were inundated. But what we had realized was we did eventually facilitate virtual consultations with these 4,500 people, and it was great. It was a great commercial opportunity, but also a somewhat tragic realization of the market that almost all of these 4,000 some elderly people were misdiagnosed, latently diagnosed, undiagnosed for chronic diseases like hypertension, diabetes, other forms of heart disease. The economic opportunity for us is we were able to send some 4,000 something online prescriptions and ended up with this incredible new patient pool. But I think it also underpins the narrative that people often think of Africa as very poor or not having access to technology or not a consuming population. But yet even semi-urban rural populations who are elderly have the desire, the need, and the ability to purchase medical products online. And it's an incredible example of how the continent is able to leapfrog. And oftentimes there are no large incumbent multinationals to disrupt. So actually taking market share and growing your business in a relatively uncompetitive environment is often easier than in more developed markets that
solve all problems. One area where we have incorporated is again through a partnership, through an organization called as Cure AI, which originates from India, is on how do you screen and diagnose patients of lung cancer on an X-ray using artificial intelligence-based technology. So you have an X-ray, and incidentally, the nodule is missed. The patient keeps on coming after a couple of years, a couple of months, the disease has progressed. But with this, we identify that these individuals could be at a high risk, could be lung cancer. So you look at this patient more closely, you do a pathological diagnosis, and then you confirm whether it is lung cancer or not. So definitely there are areas where artificial, and this is happening in Africa. This is happening in Egypt, this will happen in Morocco very soon, and also Algeria. So this is not science fiction, but this is things that we are doing. And there could be many other areas where you could use artificial intelligence as well.
I would say another big opportunity for artificial intelligence is to bridge the limited human capital, right? So I think the African Development Bank had said that Africa would need 200 years at the current population to grow enough doctors, and that's if the population didn't grow at all. I think one of the things that AI can do very effectively in primary care is symptom triage. So it's not going to replace doctors or nurses, but particularly through digital health, there are lots of very creative and very effective AI tools where you can enter your symptoms, you can upload pictures, it will tell you it is likely it is one of these three things. It'll give you a tiering of how urgent it is. And then that information can then be given to a medical professional, whether it's a doctor, whether it's a nurse, whether it's a technician. So what I think it allows the continent to do, and many frontier markets and developed markets to do, is to stretch the limited human capital available. I think it's definitely not without its risks, and it is not the equivalent of a medical degree, but I think it will allow health equity on the continent, and it will allow people at least some access to healthcare who otherwise, have very little.
Yeah. IA perhaps it's not the solution, but it's clearly help. And I can add another topic is the data. And unfortunately, in Africa, we have a lack of data. And this data is very important, especially in health. You told that each country has her diseases, and in Africa, we cannot follow all the diseases. We have no information about epidemiology of the disease. And I think that unfortunately, it's the first level of IA, but we don't have it in Africa. So I think that and things could be very easy. And I'm sure that with all what is installed now in terms of clinics and private and new hospitals, it could be easier to address. Yeah.
Well, thank you very much. We are out of time. I trust that you've all had a productive day. And thank you to my panelists.
Thank you.
welcome back to the stage Eric Schatzker.
Quick, terrific speakers, amazing conversations. Thank you, everybody, for joining us for day one of the inaugural Bloomberg New Economy Gateway Africa. I hope you've enjoyed it. I hope you have found the conversations thought-provoking. I hope you've come up with some new ideas. Of course, we'll be back here tomorrow morning for the second day of our program. This afternoon, as you may know, we have some breakout sessions that many of you have signed up for and you'll be leaving for momentarily. Just as they were before lunch, at lunch, the breakout sessions are on the other side of the reflecting pool in the networking area. There's navigating a water crisis and Africa's data economy, infrastructure, investment, and sovereignty. So just make your way over there as soon as we're done here. And most importantly, folks, later this evening, please join us in the Grand Jardin, which is on the other side of this building where we had the buffet lunch you may have seen. You may not have seen if you were participating in breakouts. It is just, if you exit this room and go left down that corridor, you'll find the garden out there. Of course, there are other ways of getting there through the hotel as well. We're meeting there at 7 p.m. for a cocktail reception. I'd love to raise a glass with you. And dinner will be served at 8 p.m. See you tonight.